Bill, we are creating jobs. I see the temporary employment dynamics and all. Are these good jobs we're creating?
Well, that's the question. Are they good jobs? I suspect that some of them are not great jobs. Some of them are at minimum wage and a little bit higher. And, the average income of American workers is proceeding higher, but not at a very rapid pace. I noticed that the hours worked in this particular report didn't increase. Yes, the participation rate went up, and I think Yellen and company would be heartened by that, because to the extent that it keeps going up, it means more and more people are coming back into the workforce and takes pressure off of their Phillips curve and off of their Taylor models. So it's not exactly a robust model from the standpoint of a hike. It may be a robust model from the standpoint of increasing economic growth, which I expect in this quarter to be about 2%.
How far away from normal is Janet Yellen's Fed?
I think they're at least 100 to 200 basis points higher in their dots than normal, and the normal is really being fought out in academic circles. Most of the research has come from the San Francisco Fed. They say that at the moment that a 0% real Fed funds rate might be the appropriate rate, which would put it about at 1.5%. The blue dots are significantly higher in the out years, and so I think the Fed still has some rethinking to do. But let me mention a point on that, Tom. I think the Fed basically, they're not faking the numbers, but they want the market to believe that hikes might come sooner and faster than expected, and that means a positive yield curve. This economy, the finance industry, banks, insurance companies, all need a positive yield curve to make substantial profits. And so to the extent that those blue dots are higher than what they might really think, if they really thought about it, then that favors bank margins, and I think what they're really shooting for is a positive yield curve as opposed to being practical in where the real interest rate is going.
Well, the question, Bill, is if you look at the projections the Fed made in December for the economy in 2016, we've basically hit all those benchmarks. So are they data dependent or not? How is the market supposed to divine where the Fed is going if they tell you we're going to raise rates based on these forecasts and then they don't?
Well, they're global data dependent, and they don't want to admit that. They want to pretend that they're the central banker for the United States. In fact, they're the central banker for the world, and they have global responsibilities because the dollar is the reserve currency. They won't really put that in print. So to the extent that currencies move, to the extent that markets have sinkholes on a global basis, to the extent that emerging market countries do worse, they've been doing better in the last few weeks, then the Fed takes that into consideration. And so data dependency extends beyond the U.S. economy, although the Fed doesn't really want to admit it.
Well, are we still worried about the dollar? The dollar has basically not moved over the last month and a half. Trade-weighted dollar has actually gone down, the trade-weighted dollar index. Even with this jobs report, there's barely a move in the dollar index. Is that still a real concern?
Well, it's a concern because of the lags. There's a 6 to 12-month lag, as you know, Mike, and we're going to be seeing the effects of a stronger dollar for at least another 6 months. But yes, the dollar has stopped going up, certainly against many of the emerging market countries. Gosh, in Brazil, it's down by 10–15%. So it's getting better from that standpoint, and to the extent that the dollar does weaken, that's a benefit as well for S&P 500 global companies that have been affected by a strong dollar in the past, and now we'll see the tailwind going forward as we move into 2016.
If you're just joining us on Bloomberg Television, Bloomberg Radio worldwide and across the nation, after the jobs report, Bill Gross of Janus Capital. Mr. Gross driving the markets higher No, wait, Mike, it was a jobs report. Futures up 2, now up 11. Dow futures up 85. And we've seen some significant yield moves, Mike, buttressing out. I can give you the recent high. The recent high off the Bloomberg, January 27th. And we came down, down, down here, and we've come right back up and now broken out on the 2-year yield. Down we go and up, up, up into a higher yield. Michael McKee, the 10-year yield up 4 basis points, 1.87%.
Well, Bill, what's the proper pricing for bonds right now, for the yield curve right now, given the fact that the economy seems to be coming back more strongly, but the Fed doesn't seem to be ready to do anything?
Well, let's look at this two ways, Mike. One, from the standpoint of what the Fed would do over the next 12 months. The market has factored in a one hike and then one hike in the year beyond that. Perhaps that's a little light, and so that would suggest perhaps that the 10-year is at a relatively low level compared to where it should be. Let's compare it, though, to the global market, and that's a key relative measure. I mean, Japanese 10 years and Japanese 30 years have gone down by 30 or 40 or 50 basis points in the past 4 or 5 weeks. And, of course, we have to compare the U.S. Treasury 10-year to the German Bund 10-year and take a spread there. And so it's not just what the Fed might do, but it's the comparison relative to global markets. And global markets, no doubt, are pulling down U.S. rates, and to the extent that Draghi, next week, continues to go into negative territory, and to the extent that the BOJ continues to move down into negative territory, then the U.S. Treasury is supported to some extent in price, and yields are capped to some extent.
Bill, help me here with the oddities of the moment. I don't mean the San Francisco 49ers or American politics. I would suggest, Bill Gross, would you explain negative rates and what it means for Janus Capital and for your unconstrained portfolio?
Well, sure. Obviously, you only want to invest in negative rates if you think they're going more negative. That would produce a higher price in terms of a bond. We don't really do that because we think the move is limited, and you can only go so negative before domestic economies become affected by it, and it becomes destructive. What we're trying to do is basically range-bound central banks. We believe that central banks won't move far, that they won't move fast, that these 50 basis point hikes in the Fed and even less in terms of the UK and Japan and the ECB, that it produces a relative stasis. It doesn't mean that rates don't move 4 basis points on a morning, but it does mean that the 10-year is bound within a 20 plus or 20 minus range, and so we sell volatility around that, and it produces a much higher yield.